Thank you, everyone, for having me here today and showing up. I hope everyone's looking forward to the start of the new year. It sounded from your conversations, a lot of you guys haven't seen each other in a while, so you're kind of catching up, reconnecting. That's always fun. Very memorable time here on campus for myself. I mean, even just driving up today, I was telling the folks that I was having lunch with the students a few minutes ago. It was a little bit of an emotional experience, driving on campus and seeing some of the old places here that brought back a lot of memories. And particularly memories of all the connections and experiences that you shared with other people here. So to the extent that you don't already appreciate that, savor these moments because, one day you'll be driving back to campus and choking up a little bit when you see some of your old places that you used to hang out. Today's conversation, and I want to keep it conversational as much as possible, is on understanding optimization tools. Two parts to that. The understanding part. Before we start thinking about this as a very heavy math topic, if you're not already coming around to this, and it took me many years in my career to come around to this, but anytime you pick up a tool, you better understand how to use that tool. Every tool has a certain set of assumptions built into it. A certain set of inputs that you're going to be expected to provide based on your own insights. Those assumptions very frequently matter and matter in very big ways, but sometimes they're so subtle that you don't always appreciate them. So rather than this being a heavy quant topic or heavy math talk, this is actually going to delve as best I can into the understanding and the purpose behind the tool itself. The other part of that understanding optimization tools is optimization tools. If it already hasn't taken root in the way you think about the financial industry as a whole, my particular niche has historically been on the asset management side, but it still applies, I think, to the broad industry as a whole. There's no longer quant and fundamental. There's just a spectrum now. And I'm involved in another company where we talk about computer coding as the language of the future. And it wasn't our idea. I'm stealing that from Steve Jobs. But computer coding as the language of the future. So it doesn't matter what career you're going to choose to go down in the finance field, the industry, whether it's asset management. It sounds like a lot of investment bankers, corporate finance, what have you. You need to know tools. You need to have these quantitative tools at your disposal. And when I was graduating, there was much clearer delineation between the type of organization that you were going to go work with, again, particularly in the asset management world. Were they a quant shop or were they not a quant shop? In my opinion, that distinction just does not exist anymore. It's just gradations of the concept of using quantitative tools. I've prepared somewhere between 30 and 45 minutes of conversational material, but as Dr. Brown had suggested, feel free to ask questions along the way. It'll stretch things out a little bit further, but I think it'll make it more enjoyable for both of us, if you guys ask questions along the way. Dr. Brown did a bit of a setup on my career and my background. I only raise this just so that you understand who's speaking to you today and who's in front of you, to give you a little bit of perspective. It might help you in asking questions or delving into topical areas that I may not actually bring up during the formal part of the presentation. So just real briefly here, I only mentioned my hometown. I don't know if anyone in this audience knows where Milton, Florida is, but it's a very podunky little town, and I say that with all the love and respect in the world, near Pensacola, Florida, on the border of Alabama and Florida. I only make mention of it because when I came to Florida, University of Florida, I was just overwhelmed. I don't know how many students are here, 50, 55,000, but I was a fish out of water, out of my element here. And, sometimes this field the investment field, finance field, can feel like it's made up of so many, accomplished people that, you just can't imagine, ever ascending to that level. Certainly don't put me in that category by any means, but that was certainly my impression when I was coming to school and then in starting my career out. And the more I've evolved in my career and the more gray hairs I've gotten over time, the more I appreciate how, similar all of our backgrounds are. And, as much as I may have thought at one point being from such relatively humble background was to me, I now look at it as a source of strength and a source of my value system that I have that I may not have gotten if I had kind of maybe grown up in kind of a different environment. Long-winded way of just saying, look, no matter what your background and where you've come from, it's really up to you from this point on as to what you ultimately achieve with your careers. So Dr. Brown had mentioned I had graduated with a undergraduate in finance from University of Florida. We had nothing like this that you guys are going through here. I really wish I did. I mean, it would have given me such a much better head start as opposed to having to go out into the workforce and kind of learn what I didn't know before deciding I needed to go back and kind of retool myself. So consider yourselves very fortunate that you're getting some very early, very good exposure to, concepts and tools that, your peers that you're going to be out there in the workforce working next to, in many cases, won't have these same opportunities. So take advantage of it. Don't do what I did, going out a little bit too much here on campus and not, spending as much time in the books as I should have. This is a great opportunity, so, don't let it go to as much waste as it did on me. I started out my career, I won't bore you with all the details here, but Dr. Brown and I spoke a little bit about serendipity earlier today. And we spoke about it even at lunch with Connor and the rest of the crew that I met with. But one of the big breaks in my career was that I was reading The Alligator one day. So I'm a Sigma Chi, so I'm waiting over there at the bus stop at my fraternity to take me into campus. So I'm always looking for internships. You guys got the internship stuff down cold. Back in the day, I was started in 1985 here. Internships were something that only a small subset of students did, and it wasn't very well organized at all. So I knew myself I wasn't the greatest student in the world. At least I felt like I can go out and find out what kind of jobs I might and might not like doing. And one of the jobs that was posted in the Alligator was what's called a student adjunct member on one of the local boards here in Gainesville. It was the General Employees Pension Plan. And I had done enough like part-time and internship jobs up until that point to know that the whole retail world did not connect well with me. I didn't feel good at what I was doing. It was just not enjoyable or gratifying work for me. And I had always heard about this institutional world. Well, so that was always in the back of my mind. Serendipity throws this classified ad to me that says, hey, student adjunct position, this board, you'll serve on this pension board overseeing, I think it was like $35 million at the time. Boy, that sounds exciting, So, serendipity came a calling, and I was ready. I didn't know where this was going to lead, but I knew it was at least going to expose me to something that I had not been exposed to before. From there, I gained, I finally met, a money manager. Wow, an actual person that does nothing but manage money, as opposed to a retail financial advisor that's on the phone and doing all sorts of other stuff besides just managing money. And I also, got to understand who we were serving. What is it that this entity is being designed around in order to serve the beneficiaries of the plan and understanding the benefit that they receive in doing a good job and overseeing the plan assets. So that was my little crack into the industry, and so I just made sure I made the most of it by, opening that door as wide as I could, meeting as many people through that experience as I could, and taking advantage of those opportunities. And that wound up kind of leading me down the path, at least initially working with Merrill Lynch. I mentioned before that I had to go back for my own retooling. So I realized fairly quickly, particularly in the investment field, that I was deficient in a lot of my quantitative tools. So I decided an MBA was something I really needed to go back and kind of do in order to kind of retool myself. And then that led to other steps along my career. Russell Investments, to the extent that it's not a household name, primarily because they primarily focus on institutional type investors, but I can look at every company along here that I've been involved with and feel like it's now a part of me. It's a part of my belief set. It's a part of how I go about making decisions now. I try to take the good from each and every one of these things and make a more complete professional that's capable of being successful in the future. So Russell had a very distinct culture, and I took that whole experience and tried to carry it through the rest of my career, including Aerostreet. My new venture, by the way, you'll notice the cluster of icons there at the bottom right-hand corner. These are a collection of companies that I'm directly involved with now after reaching a point where I wanted to be more directly involved in companies, particularly companies that were involved in change. So I felt like through my own experiences, I wanted to help pay that forward and help other people improve their own experiences that they went through. And so angel investing, I've come to the conclusion, is a way for me to do that. And so the fund I've set up is just me and my wife's assets, but the real important thing is that we spend time with these companies. We help them along. We help them progress along and improve and get the most out of what they're capable of doing, and maybe seeing potential beyond what they initially thought that they would be able to achieve. And one of the more interesting ones I'm involved with there, I'll touch on it here briefly, is called Cassini Capital Management. It's a small investment team out of Tallahassee, Florida, of all places. One of my partners there is actually an FSU grad, so that always makes for some interesting conversations. And I'm at a point in my career where I don't want to necessarily go and do another Me Too type of whatever it is. I'm always looking now to kind of get involved in a little bit more higher risk ventures, but ventures that have the potential of really having dramatic change on an industry. And this is one of those companies, in my opinion. We'll get into it in more detail here in a moment about some of the challenges that the investment industry is facing, but one of them is just the low yields that are currently available in the market. Obviously bond yields are the most front and center when you consider what they were, even in real terms, what they were compared to 5, 10, 20 years ago. But even stocks and alternative investments, return expectations have dramatically been ratcheted down. And if they haven't been ratcheted down, they're going to be ratcheted down in a very brutal way, without, people have to come to that realization sooner rather than later. But this company has a strategy that invests in basically volatility markets. And the idea here is that there are derivative instruments, whether they be futures or options, that investors use as tools in order to hedge their risks. Now, those markets in and of themselves aren't new, but the idea of building an asset management strategy that can produce higher and more diversifying returns around that is a new concept. People have been doing this maybe in little pockets off to the side in hedge funds, or deep buried within some sort of investment bank operation. They might be offering products in this area, but no one, or very extreme limited number of people are actually offering strategies in this area. And the timing is great because the return potential here, I think, is easily on par with equities, if not greater, at a time when a lot of plan sponsors, like the Gainesville General Employees Pension Plan, is now faced with the dilemma of, wow, our money is just not making as much money as it used to. How are we going to meet all of our liability obligations in the future? Yeah. So that's just a little bit of a taste of one of the more interesting companies I'm currently involved in. With that, I didn't mean that to go as long as it did, but I got off on a couple of tangents there. Before I dive in, any questions on anything we've gone over thus far? Yeah. How do I see that process?
Yeah, in terms of how do you evaluate them?
Sure. Well, I'm not in that game anymore. So take my 2 cents here as literally 2 cents worth on the topic. And I don't mean to diminish that part of my career as being something very helpful in helping me launch other successful companies afterwards. But you're, I think, basically getting at the active management challenge. There's a wide variety of different firms out there, different strategy types, all oriented around delivering value to a client. Value can be defined a lot of different ways. Typically, it's some sort of benchmark relative evaluation. And it's, I've seen the pendulum swing 1,000 different ways over even a relatively short career, I would say, in financial market terms that I've had. And, times managers in unison will all sing from the same hymn book and say, oh, it's just so difficult right now to add value and this and that. And it all boils down to, what are your differential insights versus your peers? If we all agree, and I'm not saying we all do, but if we all agree that the cap-weighted benchmark is the end-all, that that's representative of the collective wisdom of all market participants, and therefore we should be measured against this thing, then by definition, there's going to be some winners, there's going to be some losers, and when you factor in transaction cost, on average, it's going to be a losing proposition. I think there's always opportunities if you have differential information, better information than other people to add value, if we're going to use that definition. Measurable value that you can deliver to clients. I don't personally think, there are times, for example, when valuation spreads become very compressed. And those are times when, at least if you're a value investor, the opportunity for making money by having cheap valued stocks revert back to some notion of fair value, or high valued stocks revert to some notion of fair value, that doesn't pay off as well as at other times. But the beauty of the capital markets is that they're constantly evolving. And so if that opportunity evaporates for some period of time, there are other opportunities that if a manager genuinely has unique insights, they can exploit those insights relative to their peers. I prefer to use a measure when I think about the opportunity for adding value. And we're getting a little inside baseball here, but I'll just take a second. It's an ex post measure as opposed to an ex ante measure, but it's still, I think, important. If you look at the spread in returns in the marketplace, at different times they're wider and narrower. All of the things being equal, if you have the same level of skill, you should be able to add more value during more volatile times. And by volatility, by the way, I'm not just talking about the markets up and down like crazy. I'm talking about intra-market volatility. What's the variability across the returns of individual stocks? What's the cross-sectional return of individual stocks? Assuming you have skill, you should have made a lot of money in that environment because the range of returns was much wider than it was during a different environment. Kind of gets at your question, I hope.
Yeah.
I want to keep you on this slide longer, but I mean, good context. Maybe. Well, the Arrow Street story. That's a very unique approach, right?
We thought it was, and our clients thought it was too, yes. Yeah, Arrow Street's a neat story, and I'll touch on it briefly, and if anyone wants to go more details, I'm happy to, if you want to. But so the idea here was that from a forming the company standpoint, I was living in Seattle at the time, working with Russell. Arrow Street was not formed yet, but it was in the minds of several guys that were working at another asset management firm in Boston. And I'd actually interviewed at that firm and just decided the fit wasn't right. But once I got wind that they were wanting to leave their firm, very quickly after them leaving, we kind of started conversations and wanted to build something. This was back in the day now when there was a more clear distinction between quant and non-quant strategies. Because of some of the members of our team, like one of my partners was John Campbell at Harvard, an econ professor there, we had a distinctly quant flavor to what we did. But you guys are smart enough to know, that quant requires electronic data. It requires information, processing that information and making use of that in some way, shape, or form. Well, everyone kind of buys the same information. It's really special when you can find truly unique information that other people don't have. So that was the challenge that we were faced with. But we kind of came at it from a different angle. We said, what if we think about using the same information, but using it in a different way than what most people think about using it? So our real big claim to fame that's wound up serving us well since our inception was that when we evaluate an individual company, and you notice I'm still using the term we, that's how close you get to companies throughout your career if you work there long enough. But Arrow Street, their claim to fame is that instead of making an investment decision, you evaluate a company in its merits, its attributes, whatever it is that you think you have a significant insight in, and then you say, how does that compare relative to all the other options that are out there? There's value to be had there, but that's what a lot of other people do as well. Our idea was to let's not only do that, but let's bake into the mix what other related companies are also doing. So this idea that customers and suppliers, and this is probably stuff that had lived in the fundamental analyst community for many years, but let's try to quantify what a great fundamental analyst would do. This idea that we can go and maybe talk to customers. We didn't want to talk to them, but we wanted to quantitatively evaluate the customers of the subject company that we were evaluating. Or maybe the suppliers were noticing a pickup in activity from this company. Again, we were quants, we weren't picking up the phone or going to visit these companies, but we teased out a way of measuring a much more real world problem and set of information that was actually happening behind the scenes, that if we were just narrowly focusing on the individual company alone, we were blinded to. So that was our big claim to fame. We waved our hands around a lot and told the story a lot early on in our life cycle, but until some pretty significant quant events happened during the 2000s, it was really hard for us to stand out, because actually value-based investing for much of the 2000s worked pretty well. Momentum as a component, contributory signal to that worked pretty well. So it was really hard to differentiate ourselves, but really when certain types of big bumps in the road had happened, our process really stood out and as a result kind of gathered a lot of attention. Again, I can talk ad nauseum about that, and if anyone wants to hear more about it, I'm happy to later, but maybe for purposes of today's conversation, we'll kind of jump right into the topic at hand. Okay? So first off, the definition here of optimization. The key points here is the idea that trying to take something, a process, and make it as fully perfect or as effective as possible. The idea of answering the problem at hand. And the reason I start out with this definition is that if you're not already doing this, in your studies or in different jobs that you've already had, I can assure you, you're doing it in your daily lives. So if you think about your decision to come to college, come to University of Florida, that really at its heart was an optimization decision that you were making. You were trying to, you have some thought of goodness in your mind, some measure that's unique to you that you say, this is good, I want this. And maybe education, I hope, is part of that, something you view as good. So how do I, you're kind of facing this dilemma. How do I maximize this goodness? And what are all the trade-offs that I have to consider in making that decision? Well, I've got to write a check to the university. If I didn't get a scholarship, I've got to write a check every month or however, paying for your classes, whenever you write the check. I'm going to be foregoing opportunity, particularly if I stick around in a master's program and have to stay an extra year or two. There's opportunity cost associated with not going out into the workforce and earning a pay. There's the fun factor. Hey, I could be doing something else besides sitting and listening to this guy that came down from Boston to talk to us today. So there's any number of different variables that you are having to sort through and consider in making that final decision of, do I decide I want to go to University of Florida or not? Optimization in the asset management world is very much analogous to that. There's some concept, an overall, all-encompassing measure of goodness, and here are all the levers that we have to consider in making that decision, all of these different trade-offs. Okay? So for today's conversation, I purposely want to make this kind of a circular conversation because we're going to start off in talking about the theory behind a lot of this stuff, and dive into some concepts here. But what I'm basically going to do is start you out when we really get into the meat of this stuff, is take a fairly complex concept, whittle it down, hopefully to something that you'll never forget, something that will stick with you forever, because it's going to be so simple, it'll be hard not for you to walk out of this room and just be able to go boom, boom, boom. I got that, But then at the very end, and this gets back to the circular part of the presentation, I'm going to try to blow your mind a little bit by re-expanding all this and making it complex all over again, okay? So that's the roadmap of today's kind of presentation, if that meets with your guys' approval. So, who do we all have to thank for a lot of this stuff that we have to do in classes? When your professors assign you these challenging tasks and you have to whip out these tools to, solve problems and mathematical equations applied to the real world and come up with solutions. Well, certainly one of the ones that I would suggest you look to is this guy, George Dantzig. This guy, despite his somewhat frail appearance here, is actually someone I would call a World War II hero. Not because of anything he did on the battlefield, but because what he did back at headquarters. In fact, what this guy was involved with and doing was considered classified top secret information until about 1947. What was he doing? He was using linear programming in order to solve logistics problems in World War II. So we kind of think of like, to the extent that you're familiar with this space, linear programming is, it's pretty pedestrian by today's standards of, quadratic equations and quadratic programming and all the tools that we have available to us today. But I can tell you, back in his day, this stuff was quite revolutionary. Now, his problems that he was trying to solve was not to build a sensible portfolio. His problem or challenge was, how do we increase the likelihood of us winning this war by making use of a limited set of resources that we have at our disposal? So you may have heard, for example, or struggled with airline industry and trying to understand all the routes and the pricing that they have of this thing. Well, again, that's very closely related to the challenge that he was trying to solve at the time. We're trying to defeat the Germans on this particular front. But we're fighting on the Italian front simultaneously over here. How much in the way of tanks do we need in that location? What is the miles per gallon that a tank gets at any given point in time? What does that translate into how much fuel that we need to deliver to that area? Well, how many people do we need to have running the tanks, repairing the tanks, and supporting the tanks? So very quickly you can see how these logistical challenges that people are faced with can very quickly become overwhelming, much more overwhelming than any one person is capable of solving. In fact, for the solutions that he was coming up with, he would literally have teams of professionals going away for weeks and weeks at a time. That, again, stuff that you could easily solve today in just a few touches of a button on your smartphone. But that was the state of the technology at the time. But it's very much related in principle to what you guys, to the extent that you're working in an asset management firm and trying to solve a portfolio construction problem, this is very much analogous to one another. So, really, optimization, it touches on a number of topics that we've already talked about here. What are we trying to solve for? I mentioned you as a group or individually earlier in saying you have some measure of goodness or happiness in your life. And you have a number of levers over here that you're able to control in order to try to maximize that happiness that you're experiencing. Asset management, portfolio construction, typically the term that's used is called a utility function. Utility is just a fancified word of saying, yep, this factors in all these variables that we want to try to relate to our problem here. It's important to understand what are the restrictions that apply. We don't want to worry ourselves with thinking about problems that are not part of even a possible reality solution. So I'm trying to think of one off the top of my head, but a budget is a good one. You go to the mall and you see 3 different articles of clothing that you like. Well, if you've only got $150 and each one of them is $50, you kind of got to make a decision here. I can only get at least 2 of these things. I have a limit as to what I can do. Same thing with portfolio construction decisions. You may not be able to go short stocks. You may not be able to lever the portfolio. There may be some sort of regulatory restrictions as to the type of stocks you can hold. So any number of variables may need to be reflected in this utility function that we're going to talk about in a second in order to make the problem as real world as possible. But that's the key. You really want to make the problem as real world as you can. And then at the end, it just leaves you what are the remaining options to consider from there. So this will be about, ooh, that looks ugly, doesn't it? That didn't translate well into, yeah. Can I use the board here for this part? Is that okay? So we transferred this to PDF from Keynote, and it looked like some of the Greek symbols did not translate very well. Good deal. So what this is supposed to represent up here is a utility function. And I'm going to, from memory, kind of, utility is equal to something. And this something is what we're trying to approximate the real world from. And I believe what most of you think about, at least certainly initially when you think about the investment industry, is you think about this first part of the equation, and it's this idea of alpha. You know, make sure I get my notations here correctly, but you know, starting from zero and then going to 100% of the portfolio. This is my skill. My analyst went to Indonesia. He spent 2 weeks there, really digging into a number of different companies there. He came back. Here are the companies that he recommends. I'm sure that's where, or I suspect that's where most of your time and energy is you think about the asset management industry, where it's spent. And I don't want to de-emphasize that, but there's a whole other set of considerations that I just briefly alluded to earlier that go along with that you also need to consider. So this is a portion of the equation that I'm sure you are reasonably well versed in. The second part, I gather from talking to Dr. Brown, you guys are either beginning to go into that area, and maybe some of you seniors, maybe you've already kind of been in this space. But the second part of the equation, starts to take the form of risk. This is a common academic representation of a measure of risk here. And I think, if I'm not mistaken, one of the challenges that the students have been faced with is there's this investment competition program, and the investment competition is not all about just the alpha side of things. It's also about delivering risk in line with what was expected. And so, now you can see this concept of this ugly looking U that I drew here. This concept of utility is starting to bring in something more than it's all about just making money. There's a real world that we live in, and frequently, speaking about the asset management industry, a client will impose upon you a certain set of risk tolerances that they're comfortable with. Frequently in my world, because we were so benchmark oriented, at least at Arrow Street, that measure was some measure of tracking error versus a benchmark. And so in deciding this important decision about how much weight do we place on the individual securities, we need to understand, well, what does that mean to the broader portfolio in measuring how this particular client is defining risk for us, okay? Now, before it starts to get a little nerve-wracking and thinking that we're going to go through a lot of math here, I promise you we're not. I'm really going to keep it at a concept level. But I got to set it up, though, first. Two things about that. I just talked about this risk, and through your typical algebraic calculations, you're going to look at weight and estimates of variance and covariances across all these different assets in order to estimate, well, this is what my risk is here. But you notice, I didn't talk about that. What is this thing I drew here, this lambda thing? And what is this? What's the minus sign? Why are you subtracting this thing here? So take a step back from just the ugly-looking Greek letters here and think about what we're doing at this step in this utility function. We're taking something that we all unambiguously agree is good. Higher returns are better than lower returns. I want to maximize this thing, okay? But I have to recognize I can't just hold my best stock. The client's not going to allow me to do that. I have to do some sort of trade-off here. So anything less than my best stock is going to, I need to factor that in as it's obviously going to reduce this portion of the equation, but it may actually help this portion of the equation. So I want to, whatever positive contribution that comes from this bucket, I'm going to have to recognize that there is a relationship between risk and alpha over here. Lambda is the translator, so to speak, that it takes this measure of risk and puts it on terms that this bucket understands here. So, as an example, if a client doesn't care that much about risk, I could easily adapt this problem to their situation by reducing the number here, this scale factor. If a client really cares about risk, I want to jack this baby way up. Because anytime risk goes up, I really want you to penalize utility over here. Okay? So even though we're starting out and we're looking at ugly math in Greek letters here, I want you to understand, this is the understanding part of the presentation headline. It's ugly math and painful, but there's meaning behind each component of these things. Okay?
And maybe just projecting about that world that you operate in. Minus first power, you're dividing by the
Yes.
and that's a particular price of risk in that sense.
Yes, yes. And it's a good point, too, to make that, these are all generalized concepts that will apply to, whether a client defines risk this way, or this way. The important thing is that we have a mechanism that is an attempt at reflecting the reality of the world that we faced. And again, clients care about risk. It's great if you can make 100% one year, but if the very next year you lose 50% of that, hey, my average return is still great here. What do you mean? You don't want to still invest with me? Well, no. If you can go down 50%, I'm confident you can go down even further in a worse set of circumstances. So, again, we're starting to build an equation here that's got distorted here in my PDF transfer over here. So, we also live in a world that involves transaction costs. All other things being equal, transaction costs are bad. If I have to incur a cost to do something, I better get something well more in return for that. So I'm going to start off this bucket, the transaction cost bucket over here, with a minus sign, similar to right here. And I'm not going to get too elaborate here with too many other Greek letters, but TC for transaction costs. Now, you ask yourself, okay, is there a limit to the transaction cost I want to incur, or what is it that I want to try to capture here? Well, through this kind of quadratic programming, the math that's happening behind the scenes when an optimizer is churning through this problem that you fed it, it's altering these weights across all of your different assets. And depending on how big those weights are, you're going to have to incur transaction cost in order to get there. So bid-ask spread. Typically in the asset management industry, you take a midpoint between the bid and ask spread, said, look, on average, I might when I'm buying the stock, I might hit on the bid, I might get hit on the offer, but on average, I'll be somewhere in between. So I'm going to incur at least half of that cost. I'm going to go ahead and factor that in. There's market impact cost. Maybe I'm only 1% of that day's trading volume. Okay, my impact cost is going to be relatively small. Maybe I'm 25% of that day's volume, in which case I better account for a greater amount of impact cost here. So behind the scenes, the quadratic programming tool, is looping through a number of these these W's, weights, in order to, and that has effects on this particular variable here, okay, transaction costs. Now let me look at to catch up with my own notes here. Yeah, a good way of thinking about this particular issue is you're all familiar with the concept of like an efficient frontier. This idea that you have these alpha expectations and a certain level of risk associated with them. You normally think about this as probably, I'm guessing you think about it in terms of individual stocks spread all over around here. You can also think about it as just random portfolios that are kind of all assembled here. And they have this feature that there is this quote-unquote efficient frontier. For every level of risk, certain level of risk, there is a portfolio that delivers to you the highest expected return associated with it. Again, risk is an ambiguous term. It can mean a lot of different things. This component here says, well, where are we? Where is the portfolio right now in this whole cluster? I haven't traded the portfolio in a couple of weeks. Some of my views have changed, whether it be on the alpha front or the risk front. Where's my portfolio drifted to such that it's no longer on this particular line? Well, okay, here's where it is. How do I get back up to that line again? Well, I could either go here, just say reduce risk in the portfolio, incur transaction costs to get back to that line. I can juice it up, get rid of some of the dogs, put some good stocks in there, and juice up the returns again, or some combination of those two, okay? Every single one of those things is going to require transaction cost in order to affect that change in the portfolio. So much so, by the way, if you think about it, I'll give you an obvious exaggerated example. But what if to get to anywhere on that line, it cost you 5% of your portfolio's value? Why do it? Yeah, it's on the quote-unquote efficient frontier, but you know what? It's not worth it that much. An approximate portfolio that perhaps gets you to right here, near that line, it improves the portfolio attributes on these two dimensions, and it helps blunt the negative effect that we otherwise want to pay attention, that we otherwise want to pay towards transaction costs. Okay? So, real world, taking ugly academic-looking Greek letters and translating them into the real world that we're all trying to solve for here. Okay? Now, there's other things that we can also take into consideration. And I'm going to just call these penalty functions. By the way, you notice I used another Greek letter here as well. The idea here is that I need to find out a way of relating the relative importance of this component of the formula to this component of the formula. Okay? So every time I'm introducing a scale that relates this concept to that. Theoretically, I guess there's situations in which you would be less concerned about transaction costs. Maybe the customer, has certain other considerations that are so much more important that we're willing to kind of churn through costs in the process in order to achieve some other desirable goal that they have. Those are hard to imagine, but I at least just want to throw them out that transaction costs can be more or less important in the whole consideration. The next category I'm just going to call penalty 1 and penalty 2. So here's a situation. For me, this concept was probably best explained to me by Ken Levy of asset management firm up in New York, Jacobs Levy. The idea here is that, well, what if there's something like sector exposure, where we want to pay attention to, by the way, frequently this takes on some sort of like a nonlinear flavor to it. But what if there's something that's like, man, obviously we care about these other things. I want you to make me a lot of money. But man, you know what? I have to really hug the benchmark in order to answer to my board. My board is really on me all the time about us deviating at a sector level away from the benchmark. So, can you promise me only take bets away from the benchmark at a sector level only when you find there are really compelling opportunities for doing so? So you can imagine, that's just one example. Maybe I can think about like a lot of the social-based investing now, where yes, we really don't want to encourage smoking or these other type of bad behaviors by society, unless there's a lot of money to be made, for a real short period of time. So this is a means by which we can introduce something, an element of our process that looks like this. See this? We'll just call this deviation, and we'll call this negative utility, because that's what it is. We're trying to like come up with a grand, all-encompassing measure of goodness. And so I'm just going to call, hey, how much does this detract from goodness, depending on how far away you deviate from this? And you can tell this is a nonlinear function. And in the way this nonlinear function is drawn, the further you deviate, the more negative utility you introduce at an accelerated rate. So like, all right, I'm okay with you deviating from the benchmark, maybe plus or minus 1%. But boy, if you go out to 2%, that should be plus 1%. If you go out to here, man, I really want you better have enough alpha that comes from this piece of the equation such that the overall utility, not just this one contributor to utility, but for the overall utility better be much more improved because of the net effect of this combined with this. So if the tools you're currently using have some element of a penalty function in it, which by the way many quadratic optimizers do, this is effectively as kind of what's taking place. And you can imagine, you can specify this, and this is where you, as living, breathing individuals, smart people, enter the equation. You, as the user of this tool, need to understand what are all the implications based on the way that this thing is specified. So is this really what the client said? Maybe they actually said something different than that, in which case we'll need to modify this part of the equation. Okay. Before I answer your question, is his question picked up by the mic very well? Do you know? Is it? Sure. So I'm going to repeat it for the benefit of not only you guys here, but anyone watching the video. The question was, how, and if I don't restate this correctly, tell me. How often do you find that the clients are imposing these type of restrictions on you as a manager? How do they do it? And how much can it impede on the alpha generating ability of the strategy? That's the question? Good. It's almost like you're a plant in the audience, because remember I mentioned in the setup that I wanted to take what otherwise was a complex topic, distill it down into really simple English elements that we all could, you don't have to be a math major at all to understand what I've said to you thus far. But then I was going to explode it back up and make it more complicated again. It is very frequent that clients will impose restrictions on you. They do impede your ability to add value, all of the things being equal. Anytime that a manager has skill and insights, the removal or the imposition of any restrictions on that, almost by definition, means, well, I can't maximize that delivery of value to you. It very well may be for good reason that the client is imposing those restrictions. We have to pay homage to that. It's not our money, but we have to respect what they desire of us. So I mentioned earlier social-based investing. ESG is the term that's frequently thrown around these days. It's kind of a catch-all for this style of investing. Tracking error. Hey, I don't want to have to go to my board. They're really squeamish. They really look at annual performance. They can understand individual months or quarters that might be a little shaky, but at the end of the year, if you're underwater versus the benchmark, you better not be underwater by very much. So they're imposing a tracking error restriction. They're saying, well, if that's the case, I can't take as big of a bets away from the benchmark as otherwise possible. So the plant point that I wanted to make when I re-expand this formula out to be actually even more complicated than you may even appreciate is the very point that you're raising here. All of you, as living, breathing, intelligent professionals coming out of the MSF program here, should consider part of your job to go back and educate people, your clients that you're working with. Have a dialogue with them so that they can better understand what you're asking me to do has these implications. Are you aware of that? If you're not, let me help you to understand it further and kind of get you up to speed to where I think you'll be in a better place to make a better decision. So that's where, as living, breathing investment professionals that will understand this stuff, you'll understand it so well that you'll have a better appreciation, understanding for the implications for these restrictions that you're having to operate under.
Position limits, you can just show them if we're active.
Yes.
On the penalty, how much you ran across the street and other places, but my experience has been this way. Pros of litigation. Thought, but well, everybody, why'd you buy that?
Yeah, everyone
Rational
saw
person
that.
Recognize that it's priced in, but you're like bill asymmetric payoff.
Right.
Why'd you buy Bear Stearns in the middle of this?
Yeah, so
You almost have to own that.
yeah, it's kind of like the real world optimization problems we're solving every day in our own minds. In this case,
Customers are going to look at certain,
yeah,
look at the performance of certain.
yeah. So yeah, and that, that's an interesting way of presenting it, because maybe the function in that case, is it looks like this. My exposure to bankrupt companies. Well, we all have seen the data. We know there's money that can be made there, but my God, when a client, you have to sit down in front of a client and describe it, there's a real trade-off that you have to really think about. Maybe my overweight exposure versus underweight exposure, I'll call that as a negative, maybe the function, instead of being this nice uniform squared term that I kind of drew before, maybe it looks something more like this. And you could come up with an expression for this shape, this functional form. And the idea here is that boy, the more exposed I get to companies in the middle of litigation, I sure as hell better get a bump over here in order to make up for this penalty that I'm imposing on myself. So this is taking the mind of a fundamental shop who's trying to make this decision about, do I invest in this bankrupt company? And again, you can do quant shop because again, there's no delineation anymore. But this is effectively what's going on in the portfolio manager's mind when they're thinking about this opportunity, you know. So again, I'm just really trying to sell you guys on the idea that don't be afraid of Greeks. You know, they all have an underlying explanation associated with them, or at least they should. And if they don't have a solid underlying explanation under them, you better run for the hills because you're about to be fooled by math and a lot of fancy-looking computers that are having smoke come out of them and all that kind of stuff. But unless the person running that can boil it down to you and explain to you how that relates to reality, again, get ready to run for the hills there. Okay? Other penalties. So now we've introduced this whole other world of potential for this equation, and it's this concept of penalties. You know, what about a hard penalty? You know, I never want you, and this is some clients would impose upon on us, I never want you to be more than 10% away from a sector exposure. Okay, well, what I heard you just say is you never want me to be away from it or beyond that, but I can be anywhere in between. Is that what you're saying? Okay, well, what does that functional form look like if you had to guess? You know, it's going to look like this kind of like functional form. Here's negative 10%. Here's positive 10%. And remember, we're trying to affect utility here. Well, I just want it to be, it's a negative contributor to utility. Boom, boom, boom. I want you to just go to the moon and just totally destroy my goodness of this portfolio if you ever get beyond this kind of 10% limit here. So the possibilities are limitless in terms of taking the real world that you face and putting it into a quantitative framework. And again, this is exactly what the World War II guy I talked about earlier was doing. He was coming up with a framework that allowed them to evaluate a variety of different options, changing the weights around in order to come up with a maximal solution here. Okay? So now that I've introduced the idea of maximum solution to this thing, you have to wonder, like, well, how do you do that? How do you can't keep track of all this stuff. You have to use some quantitative tool, and that's where optimization comes in order to process all of this information, okay? Now, before you think that it's out of my hands now, I've turned it over to the optimization tool, it's optimizing away, and it came up with an answer, you need to understand, well, what is it trying to do? So it's trying to maximize this, okay? And once it reaches that maximum level, you see in the equation, these two things are equal to one another. So how do I get to a maximum level here? And this is where, differential equations come into play. I want to find, where is this? Here's my utility, U, and here is something. We'll just call it X, or maybe it's the W, since that's the thing that we're finagling around with. Where is that? So the concept is that you need to find where that slope of that equation is equal to 0. Okay? So how do you do that? Or more importantly, how does this tool that you've bought and you've paid hundreds of thousands of dollars for, once you go to your big firm and you're managing billions of dollars, how is it doing this thing?
You just add a little humor into it, doing it as opposed to try every single combination of permutations you know, using right down the value
Yes.
until they get to the answer.
Yes, yes. So we take the first derivative of this thing, move this to the other side of the equation, which subtracts it, and we just set it, then that should be equal to 0. Sitting in calculus class back here in whatever it was, 1987 on campus here, when am I ever going to use this crap, It's just they're torturing us here. Here's a classic example of how that skill actually gets applied in the real world. So, take the differential of this guy, and then move this guy to the other side, set it equal to 0, and be done with it, That's how it is. All right, well, everything else, I'll just ... Well, so visually, what does that look like in terms of what's going on? So here's our set of portfolio options again. Again, I'm drawing these as portfolios, not as individual stocks. Here's our set of portfolio options. We started out here, and let's pretend, at least for the purposes of simplicity, transaction costs are not a consideration. They are in the real world, but for the purposes of explanation, let's pretend like they're not a problem here, which means, in all likelihood, getting to this efficient frontier is very likely that we could actually do it. Technically, it may not be possible depending on other client restrictions, but we'll put all that to the side. We can get to this line here somehow. Well, that's a good, so we got that part of the equation. I'm sure either through economics classes and training or through the MSF program, you've been introduced to this idea of indifference curves. I'm seeing mostly yes head shakes, so I'm going to take that as a yes. And on this particular graph, we're talking about risk, and we're talking about, we're saying return here. We're removing utility, at least for the moment. As an investor, if I could distill down all of my thoughts and beliefs and convictions and everything else, I would describe myself as, anywhere along this curve, I would kind of be indifferent as to this concept of utility, this goodness measure. Not a lot of return over here, by the way, if I'm right at this point. Not a lot of return, that's not great. Oh, but you know what? I can sleep a lot better at night. I like sleeping at night, and it's kind of good to be able to have a good night's sleep, so I'm willing to live with that. Boy, if I have to kind of be a little bit more restless at night, you better give me some more return, because I just, I'm not a good sleeper. So, maybe it looks like this, that relationship. And man, I tell you, if you're not going to allow me to sleep at night, you sure as hell better kick ass and deliver some major, major return for me, because you're way out here in danger land. I could lose my job. My board's overlooking, looking over my shoulder and whatever else, So that defines, an indifference curve. And as you're aware, you move up. There's another higher level of indifference that you might have. Every point on this line is above and superior to every point on this line here, whether it be in terms of risk or the combination of risk and return. At some point, you get your maximum indifference curve that kind of meets that portfolio here. Okay? And if you think about this, that is what's going on here with utility. It's finding this point where the slope of this stuff is identical to the slope that's hitting your indifference curve. okay? So even though we've paid lots of money for this great tool, it's incumbent upon you, particularly the more advanced you become in your career, to understand it at a deeper, more fundamental level, rather than feeling comfortable of just sitting there and doing this. Because when this goes wrong and it produces bad results, the client is not going to come and talk to your computer and have a conversation with its computer. They're going to have a conversation with you. And if you can't give the client comfort in your understanding of what's going on and why, and oh, yes, there may have been an error, and it happens all the time in the asset management industry, and here's our understanding of it and why we believe that won't happen again in the future. Think about that dialogue, not with a computer and your client. It's going to be with you and the client, and you're going to be expected to come up with some answers. Well, I'll tell you, I mean, it would be very rare that I could ever even imagine that you would throw a utility number at a client. You know, I mean, so even though we are talking a lot about it right here, we're only talking about it as a tool that you're using behind the scenes. Now, some clients, and many of them, the more technical ones, they want to understand the tools that you're using. But at the end of the day, yeah, it boils down to, and this is a good point, another planted question back there, which I'll repeat for the benefit of the video audience. You know, at what point do you become obsessive over this utility metric and placing too much emphasis on it if at the end of the day the client looks at their results and says, I'm not happy with what you've done for me? So that was the my earlier sentence or two was in response to that initial question. The plant part of your question is, and I've lost track of my thoughts. I had one. I may have to come back to that in a second, but go ahead.
I could elaborate a little bit on it. The part that's hard is that utility. Ask somebody what utility is. But it's really a risk tolerance, and it's that land. That's an art.
That's a good point.
You're managing against an index. They just use the index. And you're asking them. I don't know what you should call me. You know, how do you feel about it? And then if they can't think in standard deviation, out test, out test, I mean, you have to walk them through.
There's a distinct human element that, you know, with all this robo-investing advice and stuff online, there, I think, always be a place for the human ambiguity, you know, associated with, you know, what is it that you really want? I heard you say X, Y, and Z when we first met, but maybe they really didn't mean that. You know, maybe in their heart of hearts they want A, B, and C. And so there's just this continual, you know, aspect of the money management business, I think as well as most other industries, of the human element that goes on beyond it. What we're describing here is just a tool that you have and you will have in your arsenal when you go and work in industry. It's up to you as to how you use that tool, how smart you are in applying that tool. If it gets misused, and used incorrectly, it's also your responsibility as well. But you're absolutely right to focus on, at the end of the day, is the client happy? And it's not going to be because you reported some utility number to him that came out of your computer. It's going to be based on what they define as their happiness. And it's typically good numbers with reasonable, you know, tolerable level of volatility around producing those numbers, and you've served me well as a client. If you can do that, you know, trust me, they'll be very forgiving when it comes to all the machinations that are happening behind the scenes. Okay. So even though I didn't have the slides and some of the fancy Greek letters that supported it, I hope what I've been able to accomplish for this first 3/4 of the presentation, that's my headline to you, that we're almost done, that we've taken what my guess is for most of you kind of a complicated topic. It is for me. And even though I've worked in industry for many, many years, this continues to be a complicated topic for me. I have people that I work with that are much better at the math side of this thing than I ever will be. But always being able to come back to the roots here is an indispensable skill, I believe, for your careers going forward. So whatever you may feel about, some of the more strong math folks that you work with, understand that it's even more important to understand how the tool itself is used.
Powerful comments that before you go on to, and I think that a lot of traction with them because they land where they go home. So with that, and you said, and that's not the right answer. And then that's right, you build some
Yeah.
confidence. So we're all together, we'll try to figure this
Yeah.
out. And maybe we don't have not even think about it, but ignoring it, 0, and that's clearly not the case.
Yeah.
Or saying it's 5, then everybody working with the word. The way I was just complete thought, the way
Setting it to
parameters
0.
on those costs of those things, that's great.
Yeah, yeah. And that's life.
Yeah.
It's like much fanfare and attention is placed on some of these tools that you'll see in industry. They really do boil down, and this is the point here about Steve Jobs, they really do boil down, or at least they should, to very intuitive concepts. All this is just saying is that risk matters. I don't know exactly what number to plug in there, 1.2, 1.7, 5.2, I don't exactly know, but I know, like Dr. Brown is suggesting, it should not be 0, because that's not what we would do here in this room if we were building a portfolio. We wouldn't just hold a portfolio of one stock. We would say we need to control this somehow, and therefore bringing this into the picture along with other things. And you can imagine this could just keep on going, Becomes a very complicated problem to solve for, but it is solvable. We could try to approximate the real world as much as possible through this tool. Okay? So we've gone from complex to simple, and now I want to just spend a few minutes going back to complex again. Okay? So when we look at these things, I've been just kind of haphazardly like, yeah, transaction cost, yeah, risk estimates. But understand every single one of those things those input assumptions are going to affect the outcome that we get here. So when we think about risk in the portfolio, like, okay, well, what is risk? We kind of alluded to it a few minutes ago. Is it benchmark relative because the client says that they want to adhere to a particular benchmark? They and their consultant have come up with a 60-40 recommended allocation, 60% stocks, 40% bonds, and the benchmark they use for their stock portfolio is S&P 500. And we don't want to come behind the consultant and ignore that, so maybe we have to define risk as a benchmark relative term. Maybe this is an endowment that really thinks about what they are doing as something in perpetuity, in which case maybe they don't think about risk as a benchmark concept, but they think about it in absolute terms. Hey, we got to build some more buildings and fund some more buildings here on campus pay for some more scholarships or whatever other activities that endowments are engaged in. We really care about downside risk. We don't want to lose money. And so maybe this becomes just an absolute measure of risk. Furthermore, what is the risk, if you think about it, what is the risk of a stock? I'm sure you have the computing power yourself. If you took all 500 stocks in the S&P 500, you could come up with a historical looking variance covariance matrix for that, lickety split. If you had enough data, I think you have to have whatever it is, more than 500 points or something, and you burn up a lot of degrees of freedom by estimating a 500 by 500 matrix, but you could estimate it using historical data. But is that the right number? You really want to put that number in there, what you've seen in the past?